Have you ever really stopped to consider the incredibly intricate dance that happens before a surgeon even makes a single incision, especially in these really complex procedures, with advanced robotics?
It's mind-boggling, isn't it?
How do they even get to that point, that precision, that confidence, without ever putting a patient at risk during training?
Well, that's the key question. And what if there's a company that's not just part of the solution, but is quietly sitting right at the absolute heart of it? A company really revolutionizing surgical training and benefiting massively from this huge, rapidly expanding medical technology market.
Okay, I think I know where you're going with this. Welcome to the Deep Dive, everyone. Today, we're cutting into the fascinating world of surgical science, Sweden AB. That's ticker SUS.ST.
Right. And we've compiled quite a stack here. Investment research, company reports, deep market analyses, the works.
So what's our mission today?
Our mission, really, is to distill the most crucial insights from all this material. We want to give you a shortcut, help you understand not just what surgical science does,
Right.
but why their strategic moves are so impactful,
Right.
and how they've managed to carve out such a unique, dominant position in this, constantly evolving landscape of healthcare.
Think of it as your guide to grasping the strategy behind a market leader with a really, really compelling story.
Exactly. We're going to help you understand their strategic genius.
And you'll discover how they've engineered what some analysts are calling a quasi-monopolistic position. It's quite something. We'll look at the powerful forces driving their growth and also the unique challenges and opportunities that lie ahead for them.
This isn't just us reading a report aloud.
No, definitely not. It's about getting to the core of what makes surgical simulation such a critical, high-growth sector.
So let's begin our deep dive into surgical science. All right, so when we talk about surgical science, Sweden AB, SUD, we're not just discussing another player in the medtech space, are we? No, not at all. We're looking at the global market leader, specifically in virtual reality simulators designed purely for medical training.
They are, quite literally, building the virtual operating rooms.
That's right, where the surgeons of tomorrow and even experienced surgeons learning new techniques are trained today.
And what's really fascinating looking through these reports is how surgical science got here. It wasn't just gradual growth, was it?
No, they didn't just grow into this position. They kind of manufactured it. It wasn't organic evolution. It was this calculated, almost, some might say ruthless, strategic roll-up of their rivals.
A strategic roll-up. Okay, let's pause there. For those listening, what exactly does that mean in this context?
Sure. It's a deliberate strategy. A company acquires numerous smaller, often specialized competitors to basically consolidate market share, technology, and importantly, talent, all under one bigger umbrella. Surgical science systematically identified and just absorbed companies that were leaders in their own right.
Right, so they hoovered up the competition.
Pretty much. Integrating their tech, their customers, into their own portfolio. It let them gain this massive footprint very, very quickly.
And what's the tangible result of all that aggressive consolidation? What kind of competitive advantage does that give them now?
Well, this methodical consolidation has built what you'd call a formidable competitive moat around their business. It's a strong defense.
A moat? Okay.
And it's not just about having, fancy tech. It's underpinned by proprietary physics-based software that's key. Deep integration with the major medical device manufacturers.
One's making the actual robots.
Exactly. The big names making the surgical robots. And also, crucially, extensive clinical validation. They've built this wall around their operations, making it incredibly difficult for any newcomer to really challenge their dominance.
So, if you can, just imagine a world where every single surgeon is perfectly practiced. They've navigated every twist, every turn of a procedure, dozens, maybe hundreds of times.
All in VR.
All inside a virtual environment, refining skills, reacting to every possible complication, all before they touch a real patient. Surgical science isn't just dreaming about that world.
No, they're actively building it, making surgical training demonstrably safer, more effective for everyone involved.
Okay, so to really get how they make money and where the long-term value is, we need to understand their business model. This is kind of a dual structure, right? Two main segments.
It's quite ingenious, actually. The first part is their educational products division.
Educational products, what's that involve?
This is basically their direct-to-institution sales arm. This is where they sell those complete turnkey simulator units, The hardware, the software, the whole package.
Ah, the physical machines you might see in a hospital training center.
Exactly. They sell them directly to healthcare institutions all over the world, teaching hospitals, university medical centers, clinics. It provides that foundational training for countless medical professionals.
In the revenue model for that segment, is it mostly recurring or more like one-off sales?
It's primarily one-time sales of that hardware and software bundle. Now, there is a smaller recurring stream from service and support contracts, maintenance, and things like that.
Right.
But the bulk of the revenue is transactional. And that means this segment can be pretty sensitive to things like hospital capital expenditure budgets.
Ah, okay. So if hospital budgets get tight.
Exactly. Or broader macroeconomic conditions sour. Purchasing decisions can get delayed, so you might see some quarterly volatility, what the analysts call lumpiness in their earnings from this side of the business.
That makes sense. Capital spending can definitely be lumpy. But then there's the other side of the coin, their industry OEM segment. And our sources are pretty clear. This is the core long-term value driver. Tell us about that.
Yes, this is where the company truly, truly shines from a long-term strategic value perspective. In the industry OEM segment, Surgical Science licenses its high-margin simulation software directly to medical device companies.
Okay, licensing software, not selling hardware.
Primarily, yes. And these aren't just any companies. We're talking the world's leading robotic surgery manufacturers, names you'll recognize. Intuitive Surgical, Johnson & Johnson, Medtronic, the absolute giants of the medical device world.
Wow. Okay, so they're not making the actual surgical robots themselves,
No.
but they're building the essential training systems, the software that makes those multi-million-dollar robots effective and, crucially, safe for surgeons to actually use.
That's it, exactly.
It sounds like a classic picks and shovels play for this booming robotic surgery market.
That analogy is absolutely spot on. They're effectively insulated from some of the manufacturing risks tied to the robots themselves, right?
Mm-hmm.
Instead, they provide the critical training infrastructure that enables the entire robotic surgery revolution. They're the hidden enabler, making sure surgeons are proficient before they ever touch a patient with these incredibly advanced and very expensive machines.
So it gives you exposure to that huge growth in robotic surgery.
Without taking on the complexity of actually building the robot.
Exactly. And speaking of strategic importance, their relationship with Intuitive Surgical, the clear leader in robotic surgery, that just saw a pretty monumental shift, didn't it?
It really did. A huge development. Surgical Science secured a new agreement with Intuitive Surgical, who is their largest customer by far.
Yeah.
Specifically for Intuitive's next-generation Da Vinci 5 platform. And the key here is that it's an entirely subscription-based agreement.
Subscription-based, not like a one-time license.
Exactly. This new model starts in 2025, and it's set to profoundly enhance the quality and, importantly, the predictability of Surgical Science's recurring revenues.
Wow.
This isn't just another deal, it's a real strategic transition. It de-risks a key revenue stream, and it signals a broader move towards being a software as a service or SaaS partner.
So more like a long-term embedded partner rather than just a supplier.
Precisely. It deeply embeds Surgical Science into Intuitive's ecosystem for the long haul.
So instead of maybe a big upfront license fee or development payment, okay, so it's clear they're not just sitting back, even with that dominant position. The recent acquisition of Intelligent Ultrasound? That's another move that caught my eye in the research.
You're right to highlight it. That acquisition expands their market leadership into an adjacent and quite sizable market vertical ultrasound simulation.
So broadening their reach beyond just surgery simulation.
Exactly. And it's a clear demonstration of a repeatable playbook for growth through M&A. It shows they're not just consolidating one niche, they're actively looking to apply that same successful strategy to new related areas where their expertise in high-fidelity simulation can, potentially create similar market leadership.
Okay, makes sense. Now, all these ambitious strategic moves, the aggressive roll-up, these new SaaS agreements, these ongoing acquisitions, they all require significant financial backing, right? How healthy is Surgical Science's balance sheet to support all this?
It truly is. Well, a fortress of strength is a good way to put it. They maintain a pristine net cash balance sheet.
Net cash. So more cash than debt.
Significantly more. At the end of fiscal year 2024, they had SEK 732.7 million in net cash. Even after some recent movements, including part of the Intelligent Ultrasound acquisition cost, they still held SEK 610.2 million as of June 30, 2025.
Wow.
This provides significant optionality, flexibility. They can pursue further value-accretive M&A without straining themselves financially. This is a company with serious dry powder.
Dry powder, cash ready to deploy. That's a strong position,
Mm.
especially when you consider some of the recent financial, well, volatility our sources point to.
Yeah.
It hasn't been entirely smooth sailing on the P&L lately, has it?
That's correct. It's been a bit more choppy recently. After that explosive growth in 2021, 2022, which was largely fueled by those big acquisitions like Mimic and Symbionix.
Right, where revenue jumped to 250% and then 119%. Incredible numbers.
Exactly. After that, their top-line performance moderated significantly. Revenue was essentially flat in fiscal year. 2024 grew only 0.1%. And the first half of 2025 has also been volatile. They had a strong Q1 driven by a 33% year-over-year increase, partly thanks to the intelligent ultrasound contribution kicking in.
Yeah.
But then they saw a notably weak Q2. Net sales actually declined 2% year-over-year in Q2. And a big factor there was a significant negative currency revaluation effect, SEK 24.7 million, which really weighed on their operating profit. They actually reported an operating loss of SEK nesty 2.4 million for that quarter.
Ouch. So currency headwinds hit them hard, and the sales decline.
Management attributed the Q2 sales weakness largely to delayed customer orders, particularly in the educational segment, so things getting pushed out.
Okay, so even a market leader with a strong moat isn't entirely immune to macro headwinds, budget cycles, or currency fluctuations. That's clear.
Definitely not.
And as we continue this deep dive, it's probably worth flagging some initial risks that jump out from our sources right away. That cyclicality in the educational product segment you mentioned, the premium valuation they currently command in the market, we'll get into that, and also the inherent integration risks from juggling multiple complex acquisitions. Those are all key things we need to explore in more detail later on.
Absolutely. All critical considerations.
Okay, let's zoom out for a second.
Mm-hmm.
Place surgical science within its broader context, because this isn't just a strong company operating in a vacuum, right? It's riding some truly powerful, long-term secular tailwinds within the whole medical simulation market.
That's exactly right. This isn't some small niche anymore. It's rapidly becoming a massive, growing, and frankly, indispensable part of modern healthcare training.
And the growth numbers are pretty staggering when you look at the forecasts.
They really are. And what's fascinating here is that while the precise numbers might vary a little bit depending on which market research report you look at,
Sure.
every single source we've reviewed points to the same thing: robust, double-digit growth. This isn't a speculative market anymore. It's a confirmed, accelerating trend that's fundamentally reshaping medical education globally.
So give us some numbers. What kind of scale are we talking about?
Okay, so the broader healthcare simulation market, which includes things beyond just surgical, like nursing simulation, is forecasted to grow from approximately $3.5 billion in 2025 to a staggering $12.9 billion by 2034.
Wow, $3.5 billion to almost $13 billion in less than a decade.
Yeah, that's a compound annual growth rate, a CAGR, of 15.54%. Think about that momentum.
Don't just hear those numbers. Really visualize the immense current that's pushing surgical science forward. We're talking about an entire industry poised to nearly quadruple.
It's a market tsunami, essentially.
Yeah, meaning every strategic move surgical science makes now really amplifies their position for a dramatically larger pie tomorrow.
Absolutely. And if we narrow it down just to their core focus, the specific surgical simulation market, that was valued around $554 million in 2024, but it's projected to reach approximately $1.4 billion by 2033. That's still a healthy 10.3% CAGR.
And some analyses are even more bullish.
Yes. Another analysis we saw projected an even more aggressive 16.4% CAGR for surgical simulation, reaching $1.1 billion by 2030. So regardless of the exact figures.
The message is clear. Rapid expansion.
Rapid expansion, a huge runway for a leader like surgical science.
And its impressive growth isn't just happening randomly, right? It's being fueled by some powerful, fundamental drivers that are reshaping healthcare. What are they?
There are several key ones. Probably the most impactful is the undeniable global shift towards minimally invasive surgery, and especially robotic surgery.
Right. Less invasive means more complex tools, more complex techniques.
Precisely. These aren't just buzzwords in medical journals. They represent incredibly complex, high-precision procedures that offer huge patient benefits, smaller incisions, faster recovery.
But they're harder to learn.
Much harder. They demand specialized training that simply cannot be safely or efficiently done on live patients initially. It's just not ethical or practical.
So simulation becomes the bridge,
Yeah.
the enabler.
It's the critical, non-negotiable enabler here. Surgeons must practice in a risk-free environment to master these new tools, these new techniques, before they operate on people.
And this creates a massive tailwind for surgical science because they're selling the training tools for this robotic revolution.
An enormous tailwind. The surgical robotics market itself is projected to grow at over 8% CAGR, reaching something like $134 billion by 2030.
$134 billion.
Yeah, surgical science is perfectly positioned. They're selling the essential training infrastructure that makes this whole robotic surgery revolution possible and, crucially, safe. They are the essential link in that chain.
Okay, so robotics is driver number one. What else?
Another huge one is the relentless global focus on patient safety and error reduction. This is a universal imperative across all healthcare systems.
Every hospital wants fewer mistakes, better outcomes.
Exactly. Every hospital, every government, every medical institution is constantly striving to improve patient outcomes and minimize risks. It's paramount.
And how does simulation fit into that safety picture?
It plays a pivotal, irrefutable role. It provides that risk-free, repeatable environment for surgeons to practice over and over again, to refine their psychomotor skills, that incredibly precise hand-eye coordination, and to master instrument handling before they ever step into a real OR. This directly translates to fewer errors, reduced complications, and ultimately significantly better patient safety. It's an investment that pays dividends in human lives.
That makes perfect sense.
Yeah.
Beyond safety, there's another huge global challenge that simulation can potentially help address: the worldwide surgeon shortage.
Yes, this is a massive problem with profound humanitarian implications.
How does simulation help there?
Well, it raises an important question. How do we train enough skilled surgeons quickly and effectively to meet global demand, especially when traditional apprenticeship models are slow, resource-intensive, and maybe not standardized?
Right, learning by watching takes a long time.
And access varies wildly. Estimates suggest that 5 billion people worldwide, mostly in low and middle income countries, lack access to safe surgical care precisely because there aren't enough qualified professionals.
5 billion. That's staggering.
It is. And simulation-based training offers a highly scalable and standardized solution. It can accelerate the learning curve, standardize the education of new surgeons, providing consistent, high-quality instruction regardless of geographic location. It could help bridge that critical gap much faster.
Okay, robotics, patient safety, surgeon shortage.
Yeah.
Are there tech drivers too?
Absolutely. Then, of course, there are the continuous technological advancements that are making these simulators better and better. This isn't static software. It's a rapidly evolving field.
Right. VR tech itself is improving all the time.
Exactly. The increasing sophistication of virtual reality, augmented reality, AR, artificial intelligence AI, is playing a bigger role in feedback and scenario generation, and especially haptic feedback, that incredible sense of touch that allows surgeons to feel tissue resistance or instrument interaction.
That seems critical.
It is. All these advancements are making training more realistic, more immersive, and demonstrably more effective. And that continuous improvement drives wider adoption because the benefits become undeniable and the training experience gets incredibly close to the real thing.
Here's where it gets really interesting, I think. It's not just about looking at a high-definition screen anymore, is it?
No, not at all.
These simulators are about feeling the texture and resistance of virtual tissue, reacting to unexpected virtual complications as they arise, like bleeding you didn't anticipate,
Realistic scenarios.
and getting real-time, objective feedback on your performance, everything from economy of motion to precision. That level of immersion must be what truly prepares surgeons for the unpredictable nature of a real operating room.
It absolutely is. That's the goal.
Okay, shifting our view geographically, is this simulation boom happening evenly everywhere, or are some regions leading?
No, there are definitely clear geographic dynamics at play. North America currently accounts for the lion's share, over 40% of the global market.
Why is North America so dominant?
It's really due to its advanced healthcare infrastructure, generally high technology adoption rates, and strong government support, often including funding and integration into official training programs for simulation-based training initiatives.
Makes sense. But you mentioned other regions are growing fast.
Yes, don't count out other parts of the world. Asia-Pacific is consistently identified in the research as the fastest growing market.
And what's driving that surge in Asia-Pacific?
It's primarily driven by rising healthcare investments across the region. Governments are pouring money into modernizing healthcare. Plus, there's a rapidly growing demand for skilled surgeons to meet the needs of large and often aging populations. So they're actively investing in modernizing their medical training to address critical shortages and improve care standards.
Okay. Now, earlier we touched on surgical science's formidable competitive moat. A big part of that, as our sources highlight, seems to be the incredibly high barriers to entry in this specific market.
Yes, absolutely.
These are kind of the unseen protectors that keep new players from just popping up overnight and really challenging surgical science's dominance. What makes it so hard to break into this field?
Well, first off, there's the sheer technological and scientific expertise required. Developing realistic, physics-based simulation software.
Physics-based.
Yeah, software that accurately models how surgical instruments interact with different types of human tissue, how it cuts, how it stretches, how it bleeds. That is incredibly complex.
I can imagine.
It's not something you just whip up in a garage, you know? It demands deep multidisciplinary expertise, software engineering, advanced physics modeling, detailed medical and anatomical knowledge. It's a highly specialized niche.
Okay, so the tech hurdle is high.
Yeah.
But it's not enough just to have great tech, right? You also need the medical community to buy in. You need that clinical validation and credibility.
Absolutely critical. Gaining acceptance from the, let's be honest, fairly conservative medical community is a long, arduous, and expensive process.
You have to prove it works.
You have to prove it works. You need extensive, peer-reviewed studies, independent scientific proof demonstrating that the skills learned in the simulator actually transfer to improve performance and safety in the real operating room.
And surgical science has done that.
They have. They boast over 400 validation studies. 400. That's a massive differentiator and a testament to their long-term investment and commitment. Any new entrant would face years of research, clinical trials, and substantial investment just to begin to match that level of proven credibility. And this raises an important question, maybe for you, the listener, to think about. Once a simulation solution like Surgical Sciences is deeply integrated into a major medical device manufacturer's platform, once it's incorporated into the official training curricula, maybe even reference in regulatory filings, say, with the FDA for a new robotic system, how easy do you think it is for that manufacturer to just switch to a different simulation provider?
Given the regulatory hurdles, the established training pipelines, the cost of revalidating everything, I would imagine it's incredibly difficult. Sounds like those relationships have become extremely sticky.
Exactly.
Yeah.
Extremely sticky. It's not just difficult, it's incredibly costly, time-consuming, and carries significant regulatory risk to switch.
You're right.
This creates those incredibly sticky customer relationships, especially in their industry OEM segment. And that ensures predictable, long-term revenue streams. Once a solution like Surgical Sciences is embedded with a major player, they're likely in for the long haul, which in itself becomes another powerful barrier to entry for any potential competitor.
Okay, let's really get into the engine room now, the nuts and bolts of their revenue architecture. We've talked about the two segments, educational and industry OEM, but how exactly does the money flow into surgical science from each of these? And what's the quality of that revenue?
Right, good breakdown. So in the educational products segment, like we said, it's mostly non-recurring revenue. It comes from those one-time sales of the complete simulator units.
The box.
The boxes, essentially. It's a solid business, provides that foundational training globally, but its revenue stream is subject to those capital expenditure cycles we discussed, can be less predictable day to day.
Okay. And the industry OEM side, the gold standard, as you called it.
Yeah, the industry OEM segment operates with a much more sophisticated and, frankly, attractive mix of revenue types. First, they have what's called development revenue.
Development revenue.
These are basically one-time fees, NREs, non-recurring engineering fees. They charge these for customizing their simulation software for a partner's specific device or maybe for a brand new surgical robot platform that's coming out.
Okay, so upfront payment for customization.
Exactly. Then there are also simulator sales in this segment. Often, some hardware simulators are bundled and sold alongside the launch of a new robotic system by the OEM partner.
Got it. Initial hardware placement.
Right. But the highest quality, highest margin stream and what truly makes a segment shine long-term is the license revenue.
Ah, the recurring part.
This is the core. These are recurring royalties they get from the use of their software. Traditionally, maybe tied to metrics like utilization hours or the number of robotic systems placed in hospitals.
Or increasingly, subscriptions, like with Intuitive.
Or increasingly, as we saw with the big Intuitive deal, moving towards straight subscriptions.
Yeah.
Which is even more predictable.
Okay, let's unpack that Intuitive deal again for a second. We talked about the shift to an entirely subscription-based model for their new Da Vinci 5 system starting 2025. That sounds like a really significant evolution for that high-margin license revenue stream.
Hmm.
What are the broader implications?
Oh, it is absolutely huge. I mean, what's fascinating here is just how much it de-risks that key revenue stream from their biggest customer. It dramatically improves forward visibility into their earnings,
Right.
and it increases the overall quality of those earnings. Investors pay a premium for high-quality, predictable, recurring revenue.
Definitely.
And this isn't just about getting a stable payment, right? It signals that clear transition we talked about from just being a component supplier.
To being a long-term embedded SaaS partner.
Exactly. A software as a service partner. And as we noted, public markets typically reward companies with that kind of business model with significantly higher valuations.
And crucially, you think this serves as a template.
It absolutely does. This agreement with Intuitive doesn't just benefit this one partnership. It serves as a critical template, a proof of concept for how they can structure future similar partnerships with their other OEM clients. It really cements their long-term value proposition to those partners.
Okay, so it's a model they can replicate. Makes sense. Now, beyond their financial model, their global footprint seems pretty extensive too, especially considering they started as a specialized Swedish company. Where are they operating now?
They really are global now. While headquarters are still in Gothenburg, Sweden, their operational hubs have expanded significantly, mainly through those strategic acquisitions we keep mentioning.
Right, buying talent and locations along with tech.
Exactly. They now have key development and operational centers in Tel Aviv, Israel, that came largely from the Symbionix acquisition. They have hubs in Seattle and Cleveland in the U.S., from both Mimic and Symbionix, and now Cardiff in the U.K. from the recent intelligent ultrasound deal.
So, expertise spread across key regions.
Yes, and this distributed expertise is crucial, not just for global reach, but also for tapping into diverse innovation ecosystems and talent pools.
And how do they actually sell and support their products across all these different markets?
They use a kind of hybrid approach. They have a direct sales presence in major markets like the US and China, where they have their own teams on the ground.
Okay.
But they also leverage a global network of distributors. These partners cover over 60 markets worldwide, giving them reach into smaller or more complex regions.
And the customer base itself, pretty diverse.
Incredibly diverse.
Yeah.
On the educational side, you're talking thousands of academic institutions and hospital clients globally. And interestingly, there's that notable recent expansion into the military sector.
Right, you mentioned a contract in Southeast Asia.
Yeah, a SEK 52 million procurement contract in early 2025. That could be a significant new vertical. And then in the industry OEM segment, they serve an estimated 10 to 15 leading robotic surgery companies, literally a who's who of the medical device giants.
Wow. So that breadth, both geographically and by customer type, probably helps de-risk their revenue stream somewhat too.
Absolutely. Reduces reliance on any single market or customer type, although the OEM segment is clearly the strategic core.
Okay. Now, you've mentioned a few times that their competitive moat was really built through that strategic consolidation. Let's drill down into that roll-up strategy again. How did it create this quasi-monopoly? Can you walk us through the most impactful acquisitions?
Sure. This deliberate and frankly highly effective M&A strategy was explicitly designed to consolidate what was previously a pretty fragmented market. Surgical Science basically set out to become the undisputed global leader by buying up the key pieces.
So it wasn't just about size, but about acquiring specific capabilities.
Exactly. It wasn't just acquiring companies, it was strategically acquiring key pieces of technology, crucial market share, and critical talent pools.
Okay, so which were the really pivotal deals we should know about?
Well, it arguably started getting serious with Sensigraphics back in 2019. That brought in crucial haptics technology, that sense of touch that's so important for realistic simulation.
Right, the feel.
Exactly. Then came the landmark deals in 2021. First, Mimic Technologies. This was huge. Mimic was a key competitor, and critically, they were the original simulation partner for Intuitive Surgical.
Ah, so buying them was a major strategic coup.
Massive. It neutralized a major rival and significantly strengthened their position with Intuitive, the market leader. Then, in the same year, 2021, they acquired Symbionix from 3D Systems.
Symbionix, okay, what did that bring?
Symbionix vastly expanded their product portfolio into totally new specialties, things like endovascular procedures, gastroenterology, even orthopedics. It massively diversified their offerings beyond just laparoscopy and robotics.
Got it. Broadened the platform significantly.
Hugely. And then, most recently, in 2025, the intelligent ultrasound acquisition. That instantly makes them the market leader in ultrasound simulation, a completely adjacent but very large market vertical.
So looking at that sequence, sensor graphics for haptics, Mimic to get Intuitive's partner and a key competitor, Symbionics for breath, intelligent ultrasound for a whole new vertical, they literally went out and bought their biggest rivals and key tech providers.
That's pretty much the story. They effectively eliminated direct competition in many of their core areas.
What was the combined effect of all this M&A on their competitive standing today?
Well, this series of acquisitions was both defensive removing threats and offensive building capabilities. It removed significant competitors from the playing field, creating what analysts accurately describe as a quasi-monopoly in VR simulations, specifically for robotic surgery.
And that gives them pricing power, leverage.
Significant pricing power and leverage with their OEM customers, absolutely, because there are very few, if any, viable alternatives that offer their scale, their proven track record, the breadth of their validated offerings. And that intelligent ultrasound acquisition clearly demonstrates they're capable of replicating this successful playbook in new adjacent verticals. They're not done consolidating.
Okay, that's a really strong foundation for sustained leadership. So pulling it all together now, what would you say are the absolute core pillars of their competitive advantage? The key things the listener should remember about their moat.
I break it down into maybe 4 key pillars. First, undeniably, is their technological superiority, their proprietary software, especially that complex physics engine that simulates realistic instrument-tissue interactions. That's a core intellectual property asset. It's incredibly difficult to replicate.
Okay, tech leadership, pillar 1.
Pillar 2, the sheer scale and breadth of their portfolio. Following all these acquisitions, they now offer the industry's most comprehensive suite. We're talking approximately 30 distinct simulator products covering over 150 different simulated procedures across a huge range of medical specialties. No other single player comes close to that depth and breadth of validated content.
Unmatched portfolio.
Got it.
Pillar 3, we've touched on it a lot.
Pillar 3, deep OEM integration and high switching costs. As we've discussed, those deeply embedded relationships with the major robotic companies are incredibly sticky. Once their simulation is integrated into a manufacturer's official training program, maybe even into FDA filings,
It's almost impossible to rip out and replace.
exactly. Replacing them means massive costs, development delays, regulatory headaches. It creates long-term, almost permanent partnerships in many cases.
Super sticky relationships.
Okay.
And pillar 4, something that really struck me from the research was the clinical validation aspect.
Yes, pillar 4, unmatched clinical validation. This isn't just a nice-to-have, it's utterly fundamental in medicine. Their claim of over 400 independent, peer-reviewed studies supporting the effectiveness of their simulators provides a level of credibility that is a massive, massive barrier for any potential new entrant.
You can't just build a simulator. You have to rigorously prove it works, that it makes surgeons better and safer.
Precisely. And that takes years, even decades, and millions of dollars in research funding to build that kind of evidence base.
Okay, 4 strong pillars. But maintaining that lead, especially the tech lead, requires continuous investment, right? It looks like R&D is a significant ongoing priority for them. They seem to be running a real innovation engine.
They absolutely are. R&D isn't an afterthought. It's a core part of their strategy. In Q4 2024, for example, R&D expenses were a substantial 21% of their net sales. For the full fiscal year 2024, that totaled almost SEK 185 million.
21% of sales into R&D is significant.
Very significant. And their focus is on a continuous pipeline of innovation. Developing new training modules, like they launched a pediatric advanced echo module for ultrasound in Q3 2024, and constantly expanding the procedural content available for their OEM partners as robotic capabilities evolve. They're not just maintaining their lead, they're actively pushing the boundaries of what's possible in medical simulation, ensuring their technology remains cutting edge and indispensable.
Okay, let's pivot now and really focus on the numbers. Because a compelling strategic story is great, but you need solid financials to back it up, right?
Yeah.
To really understand the strength and potential. Surgical science has had a really interesting financial trajectory over the last few years, say 2018 to 2024, characterized by, well, explosive growth followed by some recent moderation.
It really is a tale of 2 distinct periods, you could say. Revenue growth was absolutely explosive right after those big Mimic and Symbionics acquisitions closed in 2021. Sales jumped by a staggering 250% that year, hitting SEK 366.8 million.
250%. Wow. Yeah.
And then they followed that up with another 119% growth in 2022, reaching SEK 802.5 million. That was true hypergrowth. directly showing the immediate massive impact of that M&A roll-up strategy.
Incredible numbers, essentially tripling revenue in just a couple of years. But then, as you said, it seems to have leveled off quite a bit more recently. What drove that deceleration after the initial acquisition boost?
Yeah, growth definitely moderated significantly after that acquisition-fueled surge peaked. It slowed to 10% growth in 2023 and then was essentially flat, just 0.1% growth in 2024, with total sales landing at SEK 884.1 million.
Okay, so a big slowdown. Why?
The slowdown was largely attributed to a tougher macroeconomic environment hitting their educational product segment particularly hard. Hospital capital expenditure budgets tightened globally, delaying purchases of those big simulator units.
That cyclicality we talked about biting them.
Exactly. But despite that moderation in top-line growth, it's really important to note that their profitability has remained remarkably strong, which speaks volumes about the quality of the underlying business model, especially the software component.
Right, high margins.
Very high. They consistently deliver gross margins in the 68% to 71% range. That's quite impressive for any business, especially one that does involve some hardware.
Definitely.
And they've also demonstrated really strong operating leverage as they've scaled. Their adjusted EBIT margins earnings before interest and taxes reached 23.2% in 2022 and climbed even higher to 24.2% in 2023. That shows their ability to translate sales into healthy profits, thanks largely to that high-margin software licensing in the OEM segment.
And we can really see the difference between those two segments playing out in these recent numbers, can't we? Especially regarding growth versus volatility.
Oh, absolutely. The distinction is crystal clear. The industry OEM segment has been the consistent growth engine, really riding that robotic surgery wave pretty smoothly. Their high-margin license revenue, for instance, grew an impressive 50% in 2023 alone, showcasing its resilience and strategic importance.
50% growth in licenses, even as overall growth slowed. That's telling.
Very telling. In stark contrast, the educational products segment has shown much more volatility, just as we discussed. After a strong 2022, it saw only modest growth in 2023 and then actually declined by 15% in 2024.
Why the decline there?
That was hit by a combination of factors, those broader macroeconomic pressures squeezing hospital budgets, a specific government anti-corruption campaign in China that temporarily impacted healthcare spending there, and also the absence of a typical year-end budget flush from hospitals that they had benefited from in some prior years.
Okay, so that helps explain the 2024 challenges. But the first half of 2025 also brought its own set of ups and downs, didn't it? Suggesting continued near-term choppiness.
It certainly did. Q1 2025 actually started quite strong. Net sales were up 33% year over year, hitting SEK 250.7 million. Now, a chunk of that growth came from a 55% surge in the educational products segment, which included SEK 18.3 million from the newly acquired intelligent ultrasound business kicking in.
Okay, so acquisition contribution helped Q1, but profit was hit.
Right. The reported operating profit in Q1 was suppressed by about SEK 26.5 million in one-time acquisition and restructuring costs related to integrating intelligent ultrasound. So underlying performance was stronger than the headline profit number suggested.
Got it. And then Q2 saw that sharp reversal we mentioned earlier, suggests volatility is definitely still a factor right now.
A very sharp reversal. The company actually pre-announced a weaker Q2, and the final report confirmed it. Net sales declined 2% year over year to SEK 209.2 million. If you look at comparable units, excluding the acquisition, the decline was closer to 12%.
Oof, and they swung to a loss.
They swung to an operating loss of SEK negative 22.4 million for the quarter. And a huge factor there, as we noted, was that significant SEK 24.7 million negative currency revaluation effect really highlights their global exposure risk.
And the underlying sales weakness in Q2.
Management attributed the top-line weakness primarily to delays in customer order placements, particularly for simulators in the educational segment, things getting pushed out again. Now, while that's frustrating in the short term,
The orders didn't disappear.
apparently not, it did result in their order book for simulators growing by approximately SEK 30 million during that quarter. So the demand seems to be there, but the timing of when orders land can definitely be lumpy, especially in uncertain economic times.
Okay. So looking at their balance sheet and cash flow again, despite some of this recent top-line volatility and the Q2 loss, it still seems like a real fortress of strength financially, which must give them a lot of strategic flexibility.
It truly is a remarkable position. Surgical Science maintains an exceptionally strong net cash balance sheet. We mentioned the numbers over SEK 600 million in net cash as of June 2025. They have minimal debt,
Very little leverage.
almost none. And their equity to assets ratio is consistently up in the 88-92% range. That indicates a very, very low risk capital structure. It's an exceptionally well-managed balance sheet that allows them to weather these temporary storms and make strategic moves without financial strain.
And their cash flow generation, how does that look?
Historically, it's been robust. Operating cash flow was strong in 2023, around SEK 238 million. It did decline somewhat in 2024 to about SEK 137 million, reflecting the flatter revenue. And the first half of 2025 saw weaker operating cash flow, just SEK 11.3 million, mainly due to those one-time acquisition costs hitting cash and some adverse movements in working capital.
Okay.
But overall, the underlying cash generation potential remains strong, and the balance sheet provides a huge safety net and, importantly, fuel for their ongoing M&A ambitions.
Okay, so with all that context, market leadership, dual business model, recent volatility, strong balance sheet, what does the strategic outlook and future growth trajectory look like for Surgical Science now? What are the key levers they're planning to pull?
All right, looking ahead, on the organic growth front, the Industrio EM segment is really poised for continued strong growth. That's going to be driven primarily by the global rollout of new robotic surgery platforms from their key partners.
Right, like the Da Vinci 5.
Exactly. That generates those valuable upfront development fees, initial simulator sales bundled with the robots, and then critically, those long-term, high-margin license revenues, which will increasingly come from that new SaaS subscription model.
And just more robots being used means more training demand too, right?
Precisely. Increased utilization of the growing installed base of surgical robots worldwide will also steadily drive license revenue over time as more and more surgeons need to be trained and certified on their simulation platforms.
Okay, so continued strength expected from the OEM side. What about the educational products side, the more volatile segment? Is there a path to recovery and growth there?
For educational products, management themselves have expressed cautious optimism for a gradual recovery. Growth there is anticipated to come from a few areas: the launch of new products and training modules, expansion into potentially new segments like that military medical training market,
Which could be significant.
could be, and eventually just a normalization of hospital capital spending as macroeconomic pressures hopefully ease over time. It will likely remain more cyclical than the OEM business, but there are definitely avenues for renewed growth.
And it seems clear their M&A strategy, that the very strategy that built their current dominance, isn't going anywhere soon.
Not at all. It remains a core pillar of their growth strategy going forward. Management has explicitly stated in recent reports that supplementary acquisitions may be necessary for them to meet their long-term financial targets.
So more deals are likely.
Highly likely. And that strong cash position we keep mentioning provides ample firepower for them to continue executing this proven playbook. We should probably expect them to continue consolidating in attractive adjacent simulation verticals, just like they did with intelligent ultrasound.
And how are they allocating that significant capital? Given they have all that cash and generate decent cash flow, what are the priorities?
Primarily, the focus is clearly on reinvestment back into the business. Funding R&D for organic growth and innovation is key. And then, of course, funding that strategic M&A activity.
No dividends then?
No, they don't currently pay
Yeah.
a dividend, which strongly reinforces their growth-oriented strategy. They're choosing to reinvest all earnings back into the business to compound their leadership position and pursue growth, rather than distributing profits to shareholders at this stage.
Okay. In terms of leadership and governance, we've seen some changes recently too, haven't we?
Yes, a couple of notable points. The executive management team was streamlined fairly recently, going from 8 members down to 5 in late 2024, and a new CEO, Tom England, was appointed in October 2024.
Streamlining new CEO.
And the board.
The board of directors includes members with quite long tenure at the company and who hold significant personal shareholdings. That typically suggests strong alignment with long-term shareholder interests. They have skin in the game.
Right.
It is worth noting, though, that Surgical Science trades on the NASDAQ First North Growth Market in Stockholm. That's not a fully regulated main market, and as such, the company doesn't formally comply with the official Swedish corporate governance code. That's something investors should be aware of, although it's fairly common for companies listed on that specific market segment. Now, this really brings us to a critical juncture for the company, something we need to watch closely. Management previously had set quite ambitious financial targets. reaching SEK 1.5 billion in sales by 2026 with a very high 40% adjusted EBIT margin. 1.5 billion by 2026. Given the flat revenue in 2024 and the H1 2025 headwinds we just discussed, hitting that organically seems like a huge stretch.
It does. Achieving SEK 1.5 billion purely organically from their FY 2024 base of SEK 884 million would require something like a 19% compound annual growth rate through both 2025 and 2026.
Which seems unlikely without more acquisitions.
It strongly suggests that further M&A is not just likely, but almost necessary for them to hit those prior targets. And perhaps recognizing this, management is currently conducting a strategic review. They've stated they will communicate new financial targets looking beyond 2026, sometime in autumn 2025.
Okay. New targets coming soon. What does that signal?
It signals a potential shift in focus, maybe moving from that phase of rapid large-scale acquisition towards potentially greater emphasis now on integration, extracting synergies, driving operational efficiency, and charting a new, perhaps more sustainable long-term course. It's a key inflection point to watch.
That's a really pivotal moment. A strategic review and new targets. Does this imply maybe a scaling back from that super aggressive M&A? Or is it more just a refinement of the strategy? And maybe more importantly, what specific signs should we or the listeners be looking for from management later this year to judge if this potential new focus on integration and efficiency is actually working? That'll be key.
Absolutely. Execution on the new strategy and targets will be critical for market perception.
Okay, let's talk risks, because every investment carries them, right? And even a clear market leader like surgical science is no exception. We need to talk openly about what could potentially go wrong here. What are the headwinds they might face?
Absolutely crucial discussion. On the business and operational side, probably the most significant risk is customer concentration.
Reliance on a few big players.
Exactly. They have a high dependence on their industry OEM segment overall, and within that, particularly on their key partners like Intuitive Surgical, a major slowdown in robotic system sales from one of these key partners.
Or, perhaps less likely, but what if a key partner decided to develop their own simulation tech in-house?
That's the nightmare scenario, though as we discussed, the switching costs and validation hurdles make that very difficult and risky for the OEM too. But yes, if either of those things happened, a partner slowdown or bringing simulation in-house, it would have a material negative impact on Surgical Science's revenues and growth prospects.
Okay, customer concentration. What else? We talked about all those acquisitions.
Right. While strategically brilliant in building their position, that rapid pace and the complexity of integrating multiple large companies definitely carry inherent M&A integration risk.
Things can go wrong when merging companies.
Always. There's always a chance of failing to achieve the expected synergies, encountering operational disruptions as you try to merge disparate systems and company cultures, or discovering unforeseen costs that could erode the value of the deal. Management seems to have a strong track record so far, but the risk is always present with each new acquisition.
Makes sense. And in such a fast-evolving technological field like VR simulation, AI, true technological disruption, is always a lurking concern, isn't it? Could a completely new approach to training emerge and leapfrog them?
It's always a possibility. Despite their leadership position and significant R&D spend, rapid innovation means they are potentially vulnerable to new disruptive training technologies, maybe completely new VR or AR paradigms we haven't even conceived of yet.
Or just a superior competitor platform somehow emerges.
Or a competitor somehow develops a significantly superior platform that gains traction quickly. It seems unlikely given their moat, but you can never rule it out. And related to that, protecting their intellectual property, especially that core proprietary physics engine and thought infringement, would severely undermine their competitive position and that long-term moat they've built.
Okay, those are operational risks. What about broader financial and market-related risk that could impact their performance or valuation?
Well, we've seen it already. Macroeconomic sensitivity is a clear factor, particularly for their educational products segment, which is directly exposed to those cyclical hospital and government spending budgets. Economic downturns or periods of tightening budgets can and have led to delayed purchases and project cancellations. We saw that play out in 2023 and 2024.
And currency exposure, too, as Q2 2025 showed starkly.
Yes, currency exposure is a very real risk for a global company like this. They report in Swedish krona, SEK, but have significant revenues and also costs in US dollars and euros. So fluctuations in foreign exchange rates can have a material impact on their reported earnings, both positive and negative. Q2 2025 vividly illustrated the downside risk with that SEK 24.7 million negative currency revaluation effect hitting their profitability hard.
Right. And in today's world, we also have to consider geopolitical risks, especially for a company with global operations.
Indeed. They have a significant operational presence in Israel, primarily from the Symbionics acquisition, around 146 employees there as of Q1 2025. This naturally exposes the business to potential disruptions stemming from instability in the Middle East.
Have they seen any impact so far?
Management stated in late 2023 that the situation hadn't impacted deliveries at that time, but it's obviously a risk factor that requires continuous monitoring. They also mentioned they're monitoring U.S. trade policy, though they currently believe existing free trade agreements will largely mitigate most direct impacts for them. Still, geopolitical shifts are an external risk factor.
Okay, a fair few risks to keep in mind. Now let's switch gears to valuation. Our sources consistently indicate that surgical science trades at a premium valuation. Those multiples are telling us the market has some very high expectations baked in, right? Pricing in a lot of future growth.
They absolutely do. The market is definitely giving them credit for their leadership and growth potential. As of August 2025, looking at the numbers, SUS.ST trades at significant multiples. Enterprise value to last 12 months revenue, or EVLTM revenue, was around 4.5x.
Right.
And perhaps more telling is EVLTM EBITDA. That's enterprise value relative to their core operational earnings. That was sitting around 20.1x. Their forward price-to-earnings PE ratio, based on analyst estimates, was around 25.4x.
And you mentioned a trailing PE was even higher recently.
Yeah, one news report noted a trailing PE of 36.2x, which suggests there's been some multiple compression recently, likely in response to that flatter 2024 performance and the more challenging Q2 2025 results hitting sentiment. But still, these are premium multiples.
And when we try to compare them to peers, which you said is hard because they bought most of them, does that premium stand out even more?
It does. Direct public competitors are indeed scarce now due to their consolidation success. But if you compare them to, say, a broader simulation peer like CAE Inc., which does flight simulation but also some healthcare, surgical science trades at a notable premium on that key EBITDA basis. Something like 23.4x for surgical science versus maybe 16.1x for CAE in some comparisons.
Okay, a clear premium versus a broader peer. So why? Why do you think the market is willing to pay up so much for surgical science? What's the justification analysts offer for those higher multiples?
It really comes down to a combination of those strong qualitative factors we've been discussing. It's attributed to their higher margin, software-centric business model compared to more hardware-heavy peers. It's their quasi-monopolistic position in the critical robotic surgery simulation niche. And it's their stronger perceived long-term growth prospects being directly tied to that specific high-growth market.
So better margins, better market position, better growth outlook justifies the premium.
That's the argument. And this premium is even more pronounced when you compare them to other more traditional Swedish medtech companies, like Elekta, for example. Great businesses, but they don't have quite the same combination of secular tailwinds and high software margin that surgical science enjoys in its core OEM segment.
Okay, so it's a strong valuation narrative driven by market leadership, high recurring revenue, those secular tailwinds, formidable barriers to entry.
Exactly. The premium valuation is really underpinned by all those strong qualitative attributes. And critically, it's also underpinned by very high expectations for future growth. Analyst consensus projects really robust future earnings growth for surgical science.
How robust?
Forecasts we saw suggested something like 47% annual EPS growth over the next 3 years. That significantly outpaces the broader market's expected growth, maybe around 17%. This superior growth profile is a key justification embedded in that high PE ratio. Investors are essentially betting on their ability to execute and deliver on that significant potential.
But therein lies the risk, right? With such high expectations baked in, what could cause a derating, a significant drop in that valuation?
Absolutely. High expectations are a double-edged sword. A failure to meet these lofty growth expectations, which, as we've discussed with the recent slowdown and the upcoming target revisions, might be challenging, would almost certainly lead to a derating.
What else?
Significant margin compression could do it too. For instance, if integrating lower margin businesses like intelligent ultrasound proves more dilutive to overall margins than expected, or, however unlikely, if a credible new competitor actually manages to emerge, scale up, and successfully challenge their moat, Any of those could lead to a significant reevaluation downwards of the company's valuation multiples. The market demands consistent execution at these levels.
Okay. And on the flip side, what could be potential positive catalysts?
Yeah.
Things that could maybe justify the current valuation or even drive the stock higher over the longer term.
Well, successful execution of that SUS transition across more OEM partners beyond just Intuitive Surgical would be huge. Establishing that high-quality subscription model as the standard template for their partnerships would be a major positive catalyst.
Proving the model is repeatable.
Exactly. And continued value-accretive M&A. If they can keep finding smart acquisitions that truly enhance shareholder value, further consolidate their leadership, and integrate them effectively, that could provide further catalysts for a positive re-rating over the long term. Ultimately, demonstrating that they can continue to grow efficiently and profitably even as they mature will be absolutely key to sustaining and potentially growing that premium valuation.
Hashtag outro.
Well, we've now completed our deep dive into Surgical Science Sweden AB. We've really uncovered a company that's not just making medical simulators, are they? They're fundamentally shaping the future of how surgeons are trained globally. Absolutely. We've seen how their disciplined strategic acquisitions have built this really formidable, almost monopolistic moat around their core business. We've seen how their industry OEM segment acts as that high-margin engine, driving valuable recurring revenue, and how powerful global trends, patient safety, the rise of robotic surgery, even the surgeon shortage, provide these undeniable tailwinds for their continued growth.
Yeah, and despite some of that recent financial volatility we discussed, that exceptionally strong balance sheet and their unwavering commitment to innovation really seem to position them uniquely. They are a clear leader in a critical and rapidly growing sector.
It's a truly compelling story, isn't it? A company providing the essential picks and shovels, as you put it, for one of the most transformative and frankly life-saving shifts happening in modern healthcare today.
It really is. So let's leave our listeners with a final thought. As virtual reality, haptic feedback, artificial intelligence.
As all these technologies continue to advance at this incredible pace.
Getting more powerful every year. How might medical simulation evolve? Not just to improve surgical outcomes and accelerate training in advanced economies, which it's already doing,
Right.
but how might it, maybe more critically, democratize access to high-quality surgical training in underserved regions globally? Could this technology be a key part of solving that worldwide surgeon shortage, perhaps faster and more effectively than we can even imagine today?
That's a profound possibility, isn't it? Using this tech not just for enhancement, but for true global access and equity in surgical skill.
Something for you to mull over. Thanks for joining us on The Deep Dive.